everybody. Welcome to Tableside Talk. I am a commercial real estate associate with the Langert Commercial Group, and to my right here is Evan Langert, our principal and founder. Evan?
Hi everyone. As Cam said, I am the principal and founder of the Langert Commercial Group. I also am a practitioner with 35 plus years in the commercial real estate industry. That includes the past 15 years of brokerage, but it includes a long stint as a senior level attorney for large publicly traded institutions and some banking as well. So in 35 years in those roles, I've seen a whole lot of deals, a whole lot of situations, and we're doing these tableside talks so that I can take some of the experience that I have had, some of the knowledge that I've gained, and share on topics that we think will be beneficial to you. So with that having been said, what are we talking about today, Cam?
Evan, today we'll talk about investments. Of course, we've helped people purchase investments in the past with respect to commercial real estate, and I was hoping that you'd be able to speak to what are the best commercial real estate investments that someone could make.
Okay. So this is going to be a long video then. No, seriously though, that's a bit of a loaded question. Everybody's different. I'll start out with a couple of examples. So everybody knows what an apartment building is. In commercial real estate, we refer to that as multifamily. And so let's just say that you buy a 20-unit apartment building. So you have, if it's full, you have 20 tenants. Some of them, typically speaking, they work during the day, 9 to 5, 8 to 5, whatever, Monday through Friday. Other people have night jobs. Maybe a couple are retired. Maybe some others are, disabled or on, public assistance or something along those lines. So, somebody's typically there at a 20 unit or a 50 unit at all times. If you have a job during the day, a lot of people think they're home all weekend. They have friends over all weekend. They might have parties, that sort of thing. They're there in the mornings, they're there in the evenings. So there's a lot more that wears out when you've got somebody, as opposed to maybe an office building where people are there 8 hours a day and then they go home. There's a lot more that wears out in a multifamily property. Toilets can break at 2:30 in the morning, or there can be leaks or damage or things of other things that pop up at 2:30 in the morning, just like they can at 2:30 in the afternoon. So for multifamily, there tends to be very much more management intensive than a lot of things that you can invest in, and can be expensive to manage. But at the same time, depending on how the economy is, right now, especially after COVID, and as we're now in inflation and housing prices have gone up over the last few years, rents have gone up too, but interest rates have gone up and things along that line. There are a lot more people that can't afford to buy a house, so they still need somewhere to live. A lot of those people are going to rent. Some will move in with family. Regrettably, some of them are going to be homeless or live in shelters, but for the most part, they're going to rent. So the demand for rental in most places has gone way, way up, and that's made multifamily a very safe investment in most cases. So you sit there and you say, well, this is really heavy on the management. It's going to take a lot of my time, my effort. It's going to give me more heartache than some other investments might, but it's safe. And plus, if 1 out of 20 tenants moves out, I still have 19. So I haven't lost my whole investment. On the other side of the coin are what are called single tenant, triple net investments. Single tenant's pretty self-explanatory. It's a property with one tenant. Triple net just means that the tenant is paying the expenses, the property taxes, the insurance, the common area maintenance, and in a lot of cases, the roof repairs and the parking lot repairs or replacements. In a lot of cases, no, but a lot of cases, yes. And so the more, especially that a tenant's responsible for in those, the less you have to do. If you have a credit tenant, let's just say a CVS or a Dollar General, or if you have a Chick-fil-A or something along that line, a lot of times you're not doing much more than just getting a check in the mail for rent. And so, unfortunately, the returns on those are often not very good. Chick-fil-A, if you buy Chick-fil-A or McDonald's, your returns are really not very good at all. So the safety is high. There's always that continuum. There's a risk reward. If you want a lot of safety, you're not going to get much of a return. If you're willing to go with a lot less safety, you can typically get a much better return, but that return isn't, to repeat the word again, is safe. So, I used to have people invest in Dollar Generals. They're a Fortune 125 credit. They signed a 15-year lease. They were responsible for the taxes, the insurance, the maintenance, the building repairs, even if the roof, caved or needed replacement, all that stuff. You really just got a check in the mail. And they still had pretty good returns. But what happened with COVID is a lot of other single tenant investments, say some of the restaurant classes, I'm not going to mention any names, and some of these other places, well, the single tenant triple net investors found that they didn't have a tenant anymore. And there were some bankruptcies and things along that line. So I'm very cautious. And so for my clients, I always looked into our tenant, not just what's their credit, how popular are they, but are they in an industry that's likely to do well when times are bad as well as when times are good. And when we looked at that, we looked at the dollar stores because that's true of them. We looked at auto parts places because they do just fine in regular economies, but they also do well because people tend to fix their cars and not to buy new cars when times get tough. In drugstores, you had the baby boomers aging out, and there was more of a need for the types of products that you would carry in a drugstore. So we looked at those. A lot of people didn't. And now that COVID happened and what happened to their investments happened, they're not repeating that, and other people have learned by watching. So the dollar stores have gotten much, much more popular, some of the others as well. So there's more demand. So the cap rates have really compressed and come down, and the returns on those are nothing like they were 2, 3, 4, 5 years ago. So, some are very management intensive, some are not. Do you have a full-time job? Are you retired? Are you just looking for somewhere to park your money in retirement? Well, then you don't want management headaches. And you can hire a management company, say, for an apartment building. A lot of times the management companies may not be that good, and so you find yourself more involved than you want to. So you want to look at that. How much time do I have for management? How much desire and ability do I have to manage? And that should have a big say in what you're going to invest in. And then what do you like? I mean, that seems like a silly statement, but I've met people, they're like, I just love multifamily. It excites me. My dad invested in it. My grandfather invested in it. 7 of my friends invested in it. They love it, and that's what we talk about when we get together, and that sort of thing. And I hate office buildings. Or someone else says, I love retail. I've been in retail. I really like shopping centers and things along that line. So you should spend your time doing something that you enjoy. If you hate office buildings, you shouldn't invest in office buildings, in my opinion. So I think that has to play into it. And then where? You can look at around the country, and you can look at markets and sub-markets. Some states, some cities, some other locales, they're losing a lot of population. And the forecast for loss of more population is there. And that could be on a state level, it could be on a city level, it could be, I'm thinking of a situation where a company that I worked for, a large one, owned some substantial assets with substantial tenants in a pretty large Midwestern city. And what they didn't know, because they really weren't in that city much, was that the city was growing the other way. The area where their properties were was going down, more crime, less, and everybody who was building, the new retail and the new this, they were over here. So then when they lost the leases and the properties that they had a lot of trouble getting other tenants, and they ended up selling these assets, I believe, at a pretty serious discount. So where am I investing? I always try to have people invest in areas that the future's probably going to go like this. If there's going to be a lot more people moving to the city, there's going to be a lot more demand for places to live, then there's going to be a lot more demand for shopping centers and restaurants for them to visit. And people are going to start businesses, or other bigger entities are going to open branches there, so there's going to be a demand more for office space. And so, to me, I think you got to look at that. Other things, geography. I have some people, even if it's a single tenant triple net, that's like, I want to be able to see my asset, and I don't want to drive more than 3 hours. So, that's a limit. If we're in the Washington, D.C. area, Baltimore area, and someone says that, even though there might be better returns in Oklahoma or, Georgia or something else like that, I'm not going to show them those properties because their geography won't allow it. So those are a few of the things off the top of my head. There's really so much that goes into this. You have to know the area, the sub-area. You have to understand the product types and how they're trending, even within the subclasses, because A office and C office, they don't always run in the same track. Big box retail may not run in the same track as small shop boutique space or street retail. And then you have to really, really talk to the person at length that's investing to see what their time and availability and ability to manage is, whether they want to do that, where they are in the stage of life. Management can become hard in a lot of properties if you're not around them. So if you buy something in DC but you're going to retire to Florida in 2 years, that can become problematic too. There's just a lot to it. These are some high points, as it were. But as we always say at the end of these table talks, or tabletop talks,
Tableside talks.
Tableside talks, sorry. This is general information. If you have a specific situation, you should talk to us. We do not charge for initial consultations, and we're happy to help steer you in the right direction, because what's right for you isn't what's right for the next person, isn't what's right for that other person over there. So we really, really need to spend a lot of time getting to know you and getting to know, your needs, your wants, and your desires. And that's it for me.
Awesome. Well, thank you, Evan.
Yeah,
of course,
I'll try to remember that Tableside talks.
No, that's okay. Of course, folks, we will make it incredibly easy to get in touch with us. And we greatly appreciate you tuning in for this Tableside talk.
Have a great day.